Welcome to Insights. I'm Eric. Thanks for joining us this weekend. We're going to talk about the grain market. We're going to have an open discussion here. We're going to keep it relatively simple. We're going to go across the board, focus a little bit on corn while we talk about this, but really examine the entire grain market. There's a lot of price action. Price action has a lot of people, in emotional state. We went from a period of exuberance, and now we're getting into a lot of pessimism. But we really have to study all trends, whether it's the grain market or anything that's inside the matrix here. You're seeing a restricted version of this. This is the grain markets, or the grains that we follow. There's stocks, there's gold, there's energy, there's the bond market, there's some soft agricultural, there's the Forex, and then there's crypto down here. We always do the same thing. We follow assets through the evolution of the trade. It's really a study of the fractal trends of the daily, weekly, and monthly trends, how they align, how they move in and out relative to the cycles of price and time, and how they follow energy belts, which is right here. So what we're seeing right now within, and we'll talk about really corn, is corn has moved from a triple up, which the trends, anyone who's watching the corn report or the beans report or the wheat report, which is found on the report page on the website, we went from a state of triple up with extended daily and weekly, extremely extended weekly trends across the board in the grain market, to now we have a downtrend in the daily, a downtrend in the weekly, which here are breakouts down. That means that we have a finalized one count here and a one count and two count on wheat, because wheat's been leading us lower. And this market is out of alignment. Now, in terms of the evolution of the trade, the core positions were all established here. They're all highlighted red because they're all in various degrees of primary trend decline 1 or 2, 2 being the most extended. And that makes them vulnerable. Now, these are trends that are studied from 1959 and to the present. Inside the report, we talk about these cycles longer term in terms of trends that go back into the 1800s, pretty far back. Soybeans not quite as far back, but it gives you a different perspective on what can take place. The market rallied up and down from 1959. It looked a lot different between 1800 and 1955, and unfortunately, a lot of analysis out there ignores that. But this is a unique market. It's probably cannot be described solely by trading history that's taken place since the continuous contract was first originated. It has to go back further than that to understand the cycles that are in play. Some of today's cycles are consistent with the same cycles that existed during the Revolutionary War, of which there's not a lot of prices available, but it does tell you that you have to have a long look back period to understand things, and 1959 is not quite enough. So the three time frames are now down, or two time frames are down, and the primary trends are still up. You can see in terms of what these numbers, this is BU is the bull side of things, and BUS is for the price. So these are the price cycles. It's like this for everything. They're here. The price cycles, the bullish price cycles and time cycles are here. The bearish ones are on this side. You can see the highlighted box. For the primary trend, we have a price cycle that's close to 1, just slightly over 1. So it tells you that the primary trends are pushed above the normal cycles that existed between 1959. The time cycles are all above 1. But these can go as high as 2 or 2.5 before the primary trend really gets destabilized. But this is an advanced trend. These are trends that have been in place for 20 months and produced triple-digit returns before they've sold off. And now everyone's wondering, well, what can we do now that the markets are no longer in alignment? And when we talk about alignment, what we're really suggesting, and I'm going to bring this up as quick as I can, is that there's three trends that are available to us that we use here to study. They're fractal in nature. They represent a composite trend, and you can see the primary trend, secondary trend, and tertiary trend, and they go in and out of alignment. And currently what's taking place is the primary trend is up, but the secondary and tertiary trends are now down, and that represents consolidation. And cycles exist not only in price and time, but also in volatility and energy. And to get this back into alignment, we're going to need volatility to drop. We're going to need energy to pick up. And we're going to talk about that. We're going to talk about that specifically referring to corn. So as we have these, and you can see they're pretty similar. The grain market shows a very high correlation within all the assets in it. There's a lot here that we don't. We focus on the three major ones. They are highly correlated. It is difficult to send wheat down the elevator shaft without soybeans and corn following along, and vice versa. That's what correlation means. There is a strong tendency. I can show the numbers, but just trust us. We talk about some of that stuff inside the report. But one of the things that we're noticing with corn is that the two time frames are down. I've highlighted them here. When is this going to turn? Well, you're going to get some type of reaction eventually when these cycles are extended. So that's one of the things that sticks out. They're not above 2, but wheat is. Wheat fell down the elevator shaft. The whole concept of pushing on a string, if you're a short-term trader, starts to apply to wheat. You're 6 deviations away at $8 right here on WEAT is which we track. That's pretty fast, pretty far. This is going to cause some type of short covering. In terms of the price cycle, which everyone really focuses on, there's also a time cycle. Now it's pretty 32 days. Wheat fell down first. It's almost at 2 standard deviations. Wheat's going to, if any market's going to rally inside grains, it's going to be likely wheat first. But you can see the time cycles at 18 for soybeans and corn. They're just above the mean, above 0, which means they're not as destabilized as wheat, which is at 1.4. Anything below 0 is below cycle, and it's pretty stable. Anything above that, blue is kind of like a heads up, red's a warning. When it gets bolded, it's statistically extended. It is tough to push it. So wheat is looking to be pushed back up temporarily. But the problem is we're going to have to push these cycles back up, and they've just started at 1 and 2, and you say, well, how long can these cycles last? In the lead W tab, so everyone who usually gets the access to these reports, which we talk about, and we talk about like this, also has access to the matrix. So you can follow this stuff along so that you can learn to read these markets on your own without the necessarily the help. I mean, these videos do help, but without, you can confirm everything's here. You can ask any questions about it, but we always use the same standard of information, so it makes it a lot easier. So if you have your matrix available, you can open up and you can click it into the lead W tab, and then you can see all the markets that are inside the matrix. There's 45 of them that we track. We've highlighted the main grain ones, but we did that for a reason, so we could see what the weekly impulse looks like and down, and we're going to talk about what that looks like. Normally through 1959, as that's what we look through, but these are from a shorter database, and we don't tap that deep database for as many because it'll overwhelm the computer. But the average for these is like 30 to 20, you can see, but that's not what we're really interested in. What we want to know is we want to know what the weekly cycles for corn would be on a longer term basis in terms of the 1959 database, and this is the stuff that we tap into when we look at the reports as well. But the average weekly unshaded box, which is all these non-green boxes, those are downtrends. They average 20 weeks since 1959. It's about 20 and a half. So currently, when we come back to here, we can say, well, these are 1 and 2. That's a little bit early. The average down period is 20 weeks. Now, a couple of things I want to point out, and we're just going to talk about in corn. We'll slide down. Look, the weekly cycles are green boxes, and this current cycle, which I've talked about this in the report, was vulnerable because there were 0 breaks. Almost all the up boxes have some sort of break. These are the modern rallies since 1959, the 73 rally or the later 1980 rally. They all contain at least 1 break, unless you just have a shorter blip. The 2008 rally, and here's the 2011. They had 4 breaks. The 70 rally had 2 breaks. The current rally, which is from 2020, has 0 breaks, and that's the main concern. You can't have a rally without some energy that refreshes things, and this is one of the setups where you need to refresh the cycle. And I think everyone's looking at it and saying, well, we haven't had any 0 breaks, so therefore the bull market's over. It's a new bear market. That's really not how things work. The rally tends to show at least one break, and we've highlighted the 70s box with a dotted inside at the point of which it made. There was a break early, and there was a break what I would consider to be mid to late cycle. And you could say it's setting up relatively similar to that, which probably in 19 it was probably about 72-ish, the market, or 70 early 73, the market broke. We had an unshaded region, and then it took off and made higher highs. We call that a slingshot, and you're going to say it's a slingshot that requires energy, and we're going to talk about that in a second. But right now, we could have a similar setup within that, and it's provided that the energy build picks up and the energy build continues higher. And this is one of the possibilities that remains. If we slide down and look at beans, and we slide down and look at wheat, we have a similar problem. We don't have many breaks. There's usually at least two breaks. We've had one for beans. We've had none for wheat. This will be the first break right here, where it's an unshaded region. Oh, that can't be good for wheat. Well, you have 5 to 6 breaks in the 70s. You had at least one break here. I'm not sure it's as bearish as everyone's making it out to be, because you're saying that these markets never have a break in them, and then once they have a break, they can't continue higher. Well, that didn't even take place through 1959. And prior to that, these markets were even more volatile. My guess that you'd have minimum of several breaks. So the suggestion that just because the weekly trend came down, this is a new bear market, just based on that alone, that's a big assertion and a big assumption. There is a possibility that the monthly trend will come out of alignment, and under the current scenario, this is going to be a flip in progress in August, and it would be finalized in September. But in a slingshot mode where energy builds, even if it does do that, it could gather energy and ricochet higher after September, or and when you get seasonally strong period. For many of the grain markets, which we highlight here, from July, you can see a bunch of red boxes with the exception of wheat, through to about September, and then everything starts to stabilize in October, which will lead to an ideal candidate for a slingshot after that time frame. Now, these are the 1959 seasonal trends. Trends go much further back than that, and we talk about them specifically in the reports. We're not going to touch on that because this has got to be faster, and we're going to keep this one open so everyone can participate and watch. But really, the odds of a slingshot are still present today, but it requires energy. And we're going to take a quick look at that energy build, and we're going to look at not specifically one, but the entire energy build for the grain complex. And if I pull up the grain's average DI, you can see what's taking place. These are the individual builds for these, and if you want to know more, we're going to talk about these in the reports. But for corn example, it's 22, 55, and 13. Soybeans is 7, 53, and minus 10. And wheat is 13, 56, and 38, minus 38. So wheat probably has the weakest energy build, while corn has the strongest. Now, one of the things that we're noticing about energy, and this represents the composite across the three grain markets, is energy in general is building higher. Now, it's not spiked and sticking at 100. This is all three markets. It's above 40, which means there's accumulation, and it's slowly pulling up DI2. In a market that gets quite strong to turn a trend, but you can see it right here in 2021 when everyone thought a new bear market was starting as well. DI went from down here and up to here, and DI2 was down here, and it moved almost all the way up to plus 40. We're close. We're not probably a couple ticks away from that to reach that. And when we say a couple ticks, each tick is a week. So you're probably taking a couple months in duration, which probably frames this idea that we're going to have at least a 2 count or higher. And it's probably going to be bound between 2 and 20 weeks, but really it's going to be determined by energy. And anybody who's been watching, I'm going to take this chart off. You can see there's an energy build coming, but what people are concerned about would be, well, why did corn's energy build drop from the past week? It wasn't grain super weak. Well, that's not how energy builds are calculated. So I'm going to pull up another chart to discuss how energy builds are calculated, at least the period of which we use when we look at them. I'm going to bring up a corn chart. Energy builds are calculated by the CF CFTC, and which made the commitments of trader reports. A lot of people talk about them on the internet, but I don't think they handle them correctly. What our computer does, and the computer that I programmed a long time ago, it looks at the distribution across all players. It doesn't matter what the hedge funds are doing. It doesn't matter what the specs are doing. It doesn't matter what the retail. You have to look at where the money is moving on the margin across the entire distribution of leverage, which is the future and options market. It is when the market is standing in a concentration, it's pushed to one side of the boat or the other that makes the boat unstable. And that's what we're looking for in terms of energy builds. But how is energy calculated? I'm not going to talk about the details of the mathematics, but we're going to talk about the time. Energy is calculated from one Tuesday to the next. That's just how it is. The people who step into markets and try and push them around, they know this and they use that to their advantage. These arrows here highlight the points of which the DI is actually calculated, and then there's a 3-day lag in when it's released on Fridays. So it is through one Tuesday to the next. And if you want to see why the energy build here fell a little bit relative to the previous weeks, which I think corn reached about 60 or 65, and you say, well, what happened? The fact is the price was right here, and the Tuesday before that, and the today's reporting Tuesday, is at a price that's slightly higher than that. And there was a rally that took place within that few days, which in the reporting period, and that's caused the DI snapshot. There's DI, and energy builds are a function of WA, which is participation, DI, which is the snapshot of energy, and DI2, which is the trend of energy. We're most concerned about the trend of energy, the size and the build of it. It's not how hard you're getting punched in the arm once, it's how many times you get punched in a row. Even slight taps punched 100 times is going to hurt a lot more than one hard hit. And that is what we're really concerned about, is the DI2. And the DI2s for a lot of these markets are still below zero or just above zero. That means there's an energy build, it's moving in the right direction, but these have to get higher, and they have to get higher through from one Tuesday to the next. So if we fall again through, say, the Tuesday is down here, 5 days from now, 1, 2, 3, 4, 5, and it's over here, and we come back down to these lows, or we set a new low, we should see continuing build of energy, both in terms of DI and DI2. And the one aspect that we learned to talk about a lot in the reports is how much participation takes place within the energy build itself. Is WA quiet and below 20, and it's usually highlighted green. 22 is not very active either, which is a low participation environment. Markets tend to bottom under high energy builds, and low participation, they tend to top under bearish, really low energy builds, or bearish builds and low participation. And so this is a market that there's not a lot of people. People are getting squeezed out of the market. This does suggest a weak to strong hand transfer when open interest does not expand into declines and actually stays low, which is low as it can get is 0, high as it can get is 100. It does reflect likely what's taking place is that the invisible hand, in terms of the ones who control the trend, is accumulating rather than distributing. And we talk about more of this stuff inside the reports, but this is what we're following the most. We have a market, and all grain markets, whether we're talking about corn, that's fallen out of a composite alignment. The composite trend is a function of the daily, weekly, and monthly trend. It has fallen out of alignment. They no longer agree. That defines consolidation. There's no means of argument about that. That's just what's going to take place until these 3 time frames go back into upside alignment. Now, anybody who's a professional speculator, and anyone who's using this matrix, is going to wait for triple alignment to return. And it's going to closely watch these energy builds to see if there's an energy build into the decline, and particularly a large DI2 spike that takes place to power this alignment. Because when this returns to triple alignment, and everything will, it's just at what price is it going to do it? Are we going to have a sizable energy build to draw upon to fuel that? Is the invisible hand going to be standing on one side of the boat all by itself relative to the rest of the population? And they'll be all over here convinced it's all bearish, and yet then they get burned when the market takes off, and then everyone tries to slowly scamper to the other side of the boat. That's what we're looking for. That's the distribution. That's what energy is all about. And that's what we're going to look for when this thing returns to triple alignment. Will it return to triple alignment after the primary trend turns down and flips back up, say in September or October, as hypotheticals? Those are things we're going to have to talk about, but it is a possibility. But one of the things you're going to have to notice is that you're going to have to see that the invisible hand is still playing. You're going to have to look for very high numbers, likely above 60. These numbers will be well above zero. And a really strong energy build, it'll be above 60 as well. But that energy will ultimately have to be released, and you'll have to wait for the primary trend to turn back up and get the 3 time frames in alignment as well. Other things that we use to follow is the pro charts, and I'm going to just bring up corn quickly. We talk about these inside the reports a lot, and actually even in reviews. Reviews are shorter than the reports, but and they focus on more of the signals that are made, resets, flips, and other things in terms of the evolution of the trade. I'm going to pull up the Corn Pro Index, and you're going to say that they're pretty much looking like this across the board for all grains. You see a market that's fallen sharply, a lot of professional selling. The retail is buying. That's a concern for this market shorter term. You want to see the opposite. You don't care if retail buys, but you want to see professionals start to buy. What you can't probably see in the chart too well, you can see it when you blow it up and look at it in the cloud a little bit better, is that this market hasn't taken out the swing low right here. It's probably right there in the corner of that. So what we're going to want to see is the market to start to drift higher, at least start to see professional buying. That will likely come as the cycles align a little bit better. You got to get these daily cycles washed out. Maybe these are above 2. Get that time a little bit higher. And eventually we'll have to see if this is a powerful consolidation. You're likely going to take the weekly down as well, and you're going to push these cycles away from, and they're way below zero. But it is possible that these will flip back up and will defend that primary trend, and these cycles, which is currently up, they're extended a bit, but they can be extended more longer term. Some of these things don't look as bad as they seem, but really has to do with the daily and weekly at this point. The daily on wheat is pretty extreme. It needs some sort of rally shorter term. If you're selling away hard on wheat, you're pressing on a string, and most people probably don't even realize they're doing it. So we're going to be watching that. We're going to be watching energy. We're going to watch it from one Tuesday to the next. We're going to get these numbers up. And the last thing I want to comment on is the volatility, and we're starting to see some of that. This little nomenclature here in the name column is a down arrow in calm. That's compression. At one point earlier, I talked about cycles that include price and time, but there's also volatility. And I'll bring up this chart one more time if I can quickly find it. It talks about volatility, or we talk about it, and I don't talk about it too much because it doesn't come into play. You don't see expansion and compression all that often. But what's happening is these cycles move in and out of alignment, and these are the 3 time frames. Here's this, when everything starts to move up again and everything goes down, and you get a convergence of the cycles. It's usually the convergence of the cycles that you see compression. That's when all 3 time frames start to compress through a tube of toothpaste, and then you bust out the other side. You either bust out and you push it through, and if you press hard on a tube of toothpaste, and the stuff squishes out the other side and accelerate and rate and explodes all over the place. But that's because you have compression. You're taking a liquid that's in a bigger area and forcing it through a smaller opening, and it comes out in accelerated fashion. That's the whole concept of air conditioning and what is it, gas compression and other things. It's all physics, but it exists within trends as well. It is this compression state that in corn that says something is coming. It's telling us the 3 time frames are converging or aligning with one another. It's going to be down. We're either going to have a trend that breaks the ice or jumps the creek in the not too distant future because of the growing compression. Soon we'll see it in soybeans, and soon we'll see it in wheat as well. And when we do, this energy will take on a new significance. I'll take this off to the point where if we can do either one of them, compression means it's a low state. It's a low state of volatility. What follows a low state of volatility is a high state of volatility. So the only thing we really care about is whether that price is going to be up or down. Which one do we go? You're going to be watching energy and that right here to help tip us off where we go from that point. Does price jump the creek? Does price break the ice? And these are all concepts that are familiar within, the evolution of the trade and inside the website. If you subscribe to the Matrix, click this link, study up on it. What are the pieces of the evolution of trade? They're here as well somewhere. I'm going to pull them out. You've got the energy build with a nibble, which you don't want to do in a trend. That's too young. That's where you buy a bullish energy build in an aging trend, and that usually takes place only once in a while. There's some people are learning that with palladium right now, as palladium generated a fantastic bullish energy build, but yet the primary trend was too young, and I would say the computer wouldn't let you do that, and there's a reason, because the trends tend to jump around and nibbles are inconsistent. Nibbles need to follow. You can only cheat and anticipate a change in direction when the primary trend is old, either to the upside or to the downside. Then what you're looking for is a flip, which is the primary trend flips, alignment and energy phase, which is reset. That's what we're talking about with corn. We've been doing multiple times with this one. You could get to the point where the primary trends are old enough where they could flip it down and turn back up and create another flip, and then you could theoretically get a nibble and then a flip. Those are all possibilities, but it's the alignment in an energy phase, which the grain market currently is. And then you also have an aging trend, and that's denoted here with primary trend decline 1 and 2. The grain market is an aging trend because these trends have been up for 21 to 22, 23 months, and almost 2 years. They've been up longer, and they can go longer, but we have to be cautious. The primary trend and core position is still long, but once that changes, especially if there's not supporting energy build, things can change quite a bit. If you have any comments or questions about what we talked about, let us know. If not, we encourage you to follow along with the matrix and learn about how to follow the fractal trends and energy builds and cycles. Join the reports that are out there. We're going to talk about this stuff. We go into more detail, particularly about the energy build and the individual report. But this is something we just wanted to address as corn really starts to struggle out there in terms of what people are experiencing. At least in the short term. Don't focus solely on price. You have to focus on price and time cycles as well as energy and volatility in quite a bit. If you have any questions, let us know. If not, thanks for watching and enjoy the rest of your weekend.